Uncertainty about the state of the consumer and the potential impact of tariffs starting to weigh on retailers. Walmart reported strong fourth quarter results this week, but the big box retailer warns of slowing sales this year. Meantime, consumer sentiment data out today showing a sharp drop as consumer inflation expectations rise. Joining us now, we've got Stephen Yalof, Tanger CEO. Stephen, great to have you in studio with us. I just want to start on the state of the consumer. What are you seeing?
Well, first of all, thanks for having me on. Well, with regard to the consumer, I think the consumer was very present and showed a great resilience during the fourth quarter. So our holiday sales, our holiday traffic were up. And, I think in both, we have a outlet platform and we also have a full price sort of town center platform that we're starting to grow. And the customer was definitely out and shopping in both of those categories.
Stephen, I'm curious when you take a look at, and I bring this up because of the consumer sentiment numbers that we got out this morning, this expectation for inflation to rise. Is that good news to a degree, or give you at least some sort of advantage over some of your peers, especially in the outlet division, when inflation is such a concern, or what does that mean for your business?
Well, I think the outlet business definitely benefits during any sort of macroeconomic headwind because the customer is looking for value. And, when you can get, and the beautiful thing about the outlet center business, it's your favorite brands, but every day on sale. So if there's a consumer that's looking for an entry-level price point into one of their favorite brands, whether it's a luxury brand or sort of a middle brand, even Nike, it gives them the opportunity to buy the product they want at the best possible price every single day. And I think consumers really like that. They gravitate to that.
Over the, let's just say, past 4 years, how has the demo of your consumer changed? And I ask in the context of those Walmart earnings, because that's traditionally a lower income consumer that we're seeing struggling so much that they're struggling to even shop at a Walmart. We see that come up in McDonald's earnings, for example. Is the luxury outlet consumer more middle income or upper income?
Well, I think our consumer is looking for branded value. So they're not looking for commodity, meaning, sneakers at the cheapest price. They want Nikes at a great value price. So, our consumer going in is one who understands brand, and I think that that's critically important. On the higher end, I think that there's customers who may not need the latest product in the store, but want the product that they love, the brand that they love, the quality of fabrication. So in some of our stores, whether it's a Tory Burch, a Coach, a Michael Kors, or Ralph Lauren, the customer can shop and buy actual product in those stores that at obviously a value price, but give them the opportunity to get that quality that they're looking for.
Stephen, what does the foot traffic levels look like?
Yeah, our foot traffic has been great. And you asked about the demographic of the customer before, but so let me relate that to foot traffic. We've done a really good job of bringing in brands that draw a younger consumer. The health and beauty category is really the category that the younger consumer is looking for right now. You see as many people from 5 to 15 shopping in Sephora and Ulta as you do, older people in those stores. And as those stores
That's
now,
it for those parents.
and as those stores start to come into our platform, we're seeing a much younger customer. And so now we're sort of catering to that younger customer because they're the customer of the future. So we want to make sure that when they come and visit us, there's plenty of things for them to do, whether it's a better restaurant, whether it's better entertainment, experiential things, better amenities. They love loyalty programs to get rewarded for the things that they buy. We've got a great loyalty program. And then, of course, the stores that they love when they come and visit us, that's the most important part.
How are you strategically thinking about that shift in the context of also wanting to keep the older demographic of customers happy and returning as well?
Well, sure. You never want to alienate your core customer. And as some of the brands that they've gotten used to over time start to lose a little bit of market share, there's still an opportunity for them in the platform. But what we're finding is that that older consumers also, their tastes are shifting as well. Now, there's been brands that have been in the outlet business for over 50 years. You look at Ralph and some of the other brands I just rattled off before. But I think there's a lot of newness that we're bringing in. Things like American Eagle and Aerie, their brands. Abercrombie doing an unbelievable job right now. J. Crew, brand that's been around for a really long time. But again, they're going after, they got that core customer, but they're also going after a younger customer too. So it's great to see, in our space, all age groups come together and have the opportunity to shop the same stores.
Stephen, I'm curious for your business, when you step back and take a look at the macro environment right now, specifically the Fed, there's risk here that we could be in this high for longer rate environment. What is that ultimately, the implications there for your business?
Well, for us, obviously, we're in a very acquisitive state right now. So we just purchased 2 shopping centers in the last 4 months. And buying shopping centers is how we're going to grow our business right now. Development, there's not a lot of new development happening in the retail space, primarily because the cost of building right now and the cost of land is so expensive. But you can buy shopping centers, particularly those that have come on the market, where we think we can add value. The pricing has been very advantageous for us. We've got a great balance sheet. My chairman likes to say we have a fortress balance sheet. We trade about 5 times debt to EBITDA, which is pretty low and gives us a great availability of capital, so we can go out and we can buy. Interest rates, as they trade up, they certainly will make the cost of debt that much more expensive, and obviously challenge a lot of the pricing. But again, for us, we look at going in yields. The last 2 acquisitions that we made were both in that 8% going in yield, but we think that we can also add a lot of value through our leasing, our marketing, and our operations over time.
On the policy front, there's also the potential impact of President Trump's tariff policies. What is the right strategic approach? Is it stockpiling ahead of potential tariffs, or is there a risk to that when it comes to inventory as well? How are you thinking of it?
Yeah, we've been thinking about that a lot, and actually we've been speaking to a lot of retailers and asking them what their strategy is, because it really relates more to the retailers than it does to us. But obviously you can't sell the products if they're not in the stores. What the retailers have said is that they've done a really good job of diversifying away from any one geography where they're manufacturing or supply chain. A lot of that work actually started post-COVID because there was a lot of issues getting things out of certain countries right after COVID, so a lot of retailers did a really good job diversifying their sourcing, and I think a lot of that diversification is still happening. I think the retailers that haven't done a good job with it, they'll probably suffer a little bit more. But fortunately for us, our largest retailers in our platform, those are the ones that I feel really good about their ability to not only source inventory, but fill the stores, which is ultimately what the customers are looking for.
Stephen, always great to have you. Thanks so much for stopping
Thanks for
by
having
after
me here.
earnings.
I appreciate it.